Number one are covered call ETFs. You could think of an ETF like investing in a basket of stocks. So instead of investing in one company like McDonald's, I can invest in an ETF on the stock market like SPY, which will give me ownership into 500 different companies, one of which is McDonald's. Covered call ETFs work a little bit differently. When I invest in something like SPY, I'm buying this ETF because I want the stocks in this ETF to go up in value. Covered call ETFs are a little bit different because their goal is to produce monthly income for you as opposed to seeing their stock prices going up. I'll give you examples in just a minute, but they do that by doing two things. Number one, the fund manager will work to go out and buy stocks, which is the same as every other ETF. But then as soon as they buy the stock, they're also going to sell call options on that exact same stock. And if you don't know what that means, let me explain. So let's assume the stock is on sale for $100. This fund manager might buy the stock for $100 and then immediately sell an option to somebody to purchase that stock at $105. Now, when somebody buys the option to buy a stock, they're not actually buying the stock, they're just paying a fee to get that option. So now this person, the new buyer of that option, has the ability to buy the stock for $105. And you might say, well, why would anybody do that? Because now let's assume that the stock goes up to $200. Now when the stock goes up to $200, this buyer will buy the stock for $105 because they paid this option fee. Now if the stock goes down to say $50, this buyer is not going to buy the stock because they would lose money. The only thing that they lost is that option fee. So what these covered call ETFs are doing is they're buying stocks for the income for selling these options. Here's a couple examples. JEPI is a covered call ETF created by JP Morgan Chase Bank with the primary goal of creating monthly income. And at the time I'm recording this video, they're paying around an 8% annual dividend. We can compare this covered call ETF, which invests in a broad variety of stocks, with this. QYLD is a NASDAQ 100 covered call ETF, meaning they focus on companies in the NASDAQ. And at the time I'm recording this video, they're paying out an annual dividend of around 11% a year, paid out monthly. You want to pay attention to the underlying assets that these ETFs are investing in, because if markets crash or we go into a recession and these ETFs are not able to sell a lot of these options, well, that means that these ETFs are going to be holding onto those stocks. And if you're holding onto stocks that are a bunch of, well, doo-doo, it's not going to be worth much. And so if you're investing into an ETF that's investing in stocks that you believe in and markets go down, well, hopefully the markets will rebound and you'll see the value of your assets go up as well. So the pros with these types of covered call ETFs are, number one, you can create monthly income. And number two, the strategy works even if stocks are moving sideways. The cons are, number one, if the stock market booms, well, you're not seeing all the upside because remember, you're working for income and you're selling the option to buy the stocks. So even if the stock goes up to $200, you're not seeing all the upside. You're working for the income, which is that option fee. Number two, if markets crash, the value of your ETF will go down and your income will also go down, which is why, again, the assets that you're investing in are so important. That way, hopefully, you can see the value of your investments rise again. And of course, number three, you're not FDIC insured because you're investing your money in the stock market. Now, I have to remind you, I'm not telling you what to invest in. I'm just a random guy on YouTube. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. And this brings me to number two, REITs that pay you monthly. A REIT is a real estate investment trust. These are stocks on the stock market that are in the real estate business, and the reason why they're very interesting for income investors is because they have something called the 90% rule, which says that these stocks must distribute at least 90% of their taxable income to investors, which means they're required by law to pay out 90% of the profits to their investors, shareholders, people like you, in the form of dividends, and some of these REITs pay out monthly. The most popular example of this is Realty Income Trust, which has a ticker symbol O. And Realty Income Trust is in the business of investing in retail, industrial, and agricultural real estate with the goal of generating stable cash flow. That way you can get monthly dividends. And at the time I'm recording this video, Realty Income Trust is paying out around 5.5% a year in dividends. Example number two is Stag Industrial, which has a ticker symbol STAG. This is a REIT that's focused on investing in industrial properties in the United States. And at the time I'm recording this video, Stag is paying out around 4% a year year in annual dividends paid out monthly. The pros with investing in a REIT is now you get exposure to the real estate industry without having to operate and manage real estate yourself. And number two is you can create the monthly regular cash flow. The cons here are, of course, the risk. There's a risk that real estate will go down. If real estate goes down, well, that can hurt real estate companies. And not just that, the company itself also maintains a risk, because even if real estate is going up and the company is managing their cash badly, they have a bad CEO or they're not growing, well, that can also impact the value of your dividends and the value of your stock. So if this company, the stock, were to go bankrupt, you would lose everything. This is why, again, it is so important for you to look beyond just the dividend that you're getting and make sure that you're investing in good underlying assets. What is the actual thing that these things are buying? Because if things were to go bad, you want to own something that's actually worthwhile owning. And again, if you are an investor or want to become an investor, my team at Briefs Media publishes a free daily report called Market Briefs, where we break down what's happening in things like the economy, housing, stocks, crypto, and global markets into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every morning. And when you join Market Briefs, you'll also get my investing masterclass as a bonus, where I break down how you can get started as an investor and find big investment opportunities before everybody else. This investing masterclass is a bonus that you get for free just for signing up for Market Briefs. So if you want to get all of that for free, I have the link for you down in the description below. The third way to start generating monthly cash flow is by investing in government bonds. The United States government generates money through tax dollars. Now, the interesting thing about this is they spend more money than what they generate. And in order to fund that extra spending, they have to go into debt. Well, one of the ways that they can get that debt is by raising money from regular people like you and me. And now you can lend money to the United States government, and in exchange, you will get paid with interest. Now, the interesting thing about this is the United States government has pretty strong collateral, because their collateral is their taxpayers through tax dollars and the entire United States economy, not to mention that they can work with the Federal Reserve Bank to essentially print money to fund their bills. These loans to the government are called treasuries, and every economist will tell you that these are risk-free investments, because the United States government has the ability to always pay their bills, because they can either raise their taxes to pay back your interest, or they can get the money printed from the Federal Reserve Bank. Plus, the other benefit of investing in Treasury bonds is you're generally exempt from state and local taxes, which means if you're in a high tax state, like California or New York, you generally don't have to pay any state or local taxes on the money and income you make from Treasury bonds. Now, there's a couple ways that you can go out and buy these Treasury bonds. You can go directly to Treasury Direct and buy them from the United States government, or you can invest in ETFs that give you exposure to these Treasury bonds for monthly income and not have to deal with the United States government. For example, SGOV is an ETF that gives you exposure to 0 to 3 month Treasury bonds, short-term Treasury bonds, and at the time of recording this video, they're paying out a 4.7% annualized dividend that's paid out every single month. And we can compare this ETF that gives you exposure to treasuries that are 3 months or shorter to SHV, which is giving you exposure to treasuries which are 0 to 12 months long, and at the time of me recording this video, it's paying out around a 4.3% annual dividend paid out monthly. Yes, these are regular ETFs that you can buy and sell on pretty much any stock brokerage out there, but they're different than many other stocks because the goal with these is to give you exposure to treasuries. And so what you'll generally see is that these ETFs don't change in price. The only time that they fluctuate in price is when they pay out their monthly dividend. The price will drop by the amount of the dividend, but the value of the stock doesn't change because they're backed by treasuries. So you're buying these for the interest. You're not buying these to see growth in the value of your investment. So when you're investing in these types of funds, you're not FDIC insured because it's not a bank, but it's backed by the United States government. If the United States government were to go bankrupt, well, now you would lose the value here, but because the United States government is the strongest economy in the world, that's probably not very likely. So those interest payments are pretty secure. You're getting a pretty decent interest rate, but you're not seeing any growth in your principal. If the Federal Reserve Bank starts cutting interest rates more, well, then you would see the interest rate paid out by these funds drop as well. And yes, even if you buy these, you are still exempt from state and local taxes generally. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.